Hello, you're watching Market Week in Review for the week ending April 10th, 2015. I'm Alexandra Davis, coming to you from Russell Investments Global Headquarters here in Seattle, Washington, and I'm joined today by investment strategist Paul Eitelman. Welcome, Paul.
Great to meet you.
Nice to have you here. So there's a lot of focus this week on U.S. interest rates following the soft March jobs numbers. Now, the Federal Reserve talked about a meeting-by-meeting approach in their minutes this week. Did we learn anything about the likely timing of rate hikes in the U.S.?
Yeah, I think we did. There was a lot of Fed communication this week that really helped us understand how their views around the appropriate timing of interest rates has evolved from both before the non-farm payrolls report last Friday and afterwards as well. Starting with FOMC minutes from Wednesday, this was really important as a snapshot for the Fed's best thinking before the payrolls report. And we really learned two things. I think first, the Fed overwhelmingly rejected the patience language in favor for what you mentioned, which is this meeting-by-meeting approach to rate hikes. And in plain English, what a meeting-by-meeting approach means is that starting in June, basically every single Fed meeting will be a live one where they assess whether or not to hike interest rates. And the second thing we learned, which I think is really critical, is exactly how the Fed will be thinking about whether or not to hike interest rates at each meeting. This is where we're talking about the reasonably confidence language. The Fed wants to feel reasonably confident that inflation is moving back towards their 2% goal. Now, what's new about this is that the Fed's not looking so much about whether or not wage inflation is increasing, but rather more broadly if the labor market's showing significant improvement. Okay. So I think there's more emphasis now on employment growth than wage inflation, which is what we saw previously. Now, given we had this really soft 126,000 payrolls report last Friday, I think that will have shaken the Fed's confidence a bit in the labor market. So at the margin, I think a June rate hike is now much less likely. And what we also heard this week from different regional Fed presidents is that they're increasingly looking towards a September rate hike. For example, Dennis Lockhart from the Atlanta Fed basically said that he wants to give the economy more time to play out. He's much less comfortable with a June rate hike today and is in preference of either July, September, or even later. At Russell, we've been of the view for some time now that a September rate hike is the most likely outcome. And I think all of the Fed communication over the last week, including the payrolls report, just makes us more confident in that view going forward. And I think what's also important is just that rate hikes will likely start at a gradual process initially, which means the U.S. economy will have some breathing room to grow, at least quite healthily over the next couple of quarters. Okay, great. Now let's shift to Europe.
Greece made a crucial payment to the International Monetary Fund this week. First, are they out of the woods yet? And then second, what does this mean for the rest of the eurozone?
Yeah, it's a great question. I think it was a key positive step that Greece made a show of good faith to the rest of the eurozone and paid back this $460 million euro loan to the IMF. We also had positive news in the context that the ECB granted more emergency liquidity assistance to the Greek banks this week, so that's good news. But at the end of the day, Greece isn't out of the woods yet. They still need to come up with a broad package of reforms that the eurozone creditors can agree to. And markets are going to be watching this very closely as we move towards the April 24th deadline, where eurozone finance ministers have to get together and decide whether or not to give more assistance to Greece. But I think what's more interesting, and to the second point of your question, is that just how resilient the rest of Europe has been to the noise in Greece. This week, again, we've got more signs that economic growth in the region is improving. The composite PMI, which is a survey of business activity in both the manufacturing and services sectors of the economy, that increased again in April, and it actually stands at a 4-year high. So economic growth is improving as we go into the second quarter. Consumer confidence is improving. Private sector loan growth is turning incrementally more positive. And when you also add on the ECB with their aggressive quantitative easing program, I think we have all of the right tailwinds working in Europe's favor today. And the region as a whole, continental Europe, continues to be one of the areas where we see some of the most interesting and compelling investment opportunities from a tactical perspective.
Okay, great. Thanks, Paul. Now, as we look ahead to next week, what should investors be keeping their eye on?
Yeah, I think there's really two things to watch. We're getting right into Q1 earnings season in the United States now. It really kicks into high gear with some big companies reporting earnings. It's going to be critical to see how earnings come in relative to expectations. Expectations have been marked down quite aggressively for the first quarter. They've been downgraded, and that's largely on the back of the stronger dollar. But, you know, Markets are going to be focused on how these earnings come in relative to expectations. So far, I think it's been mixed, but there's some key companies to watch going forward.
Okay.
The second item is going to be U.S. retail sales. The U.S. economy really hit a soft patch in the early part of 2015. At Russell, we've been of the view that that's largely driven by a harsh winter and port strikes on the west coast of the U.S. Our view is that the U.S. economy should reaccelerate towards 3% over the remainder of this year, but the retail sales is going to be critical to watch to see if that view is actually playing out. Vehicle sales in March did it reaccelerate. I think it's going to be critical to see if the broader measure of retail sales does the same thing, either stabilizes or reaccelerates, which would confirm our view of an improving cycle in the U.S. going forward.
Okay, great. Well, we'll check back next week to see those earnings. And thank you very much, Paul, for being here today. And thank you for watching. We'll see you next time.